We're talking politics.
We're not.
Talking
We're not.
politics.
We're not.
Elon
For the
Musk.
record, we're
Elon
not.
Musk for president.
Oh,
I love
outta
Elon
here.
Musk.
See,
Steve
this is what
Bannon.
happens when all of our listeners are like, you all need to argue more. And then you start with this.
So we start with politics.
I want Elon Musk to run for president with AOC as his running mate.
No.
I can't vote, but I'll do something to support that.
This is Topline.
This episode is brought to you by the crippling fear of your typical sales process not working as well as it used to. Thankfully, it's also brought to you by Ecosystem-Led Growth, a new book by Crossbeam CEO and my good friend Bob Moore. Learn how your partner ecosystem will serve as your most efficient and scalable source of revenue growth. Sleep better at night and pre-order your copy at elgbook.com. That's elgbook.com.
AJ, how are you doing? How is your conference?
So Boston was supposed to have a nor'easter of 7 to 8 inches, and they got exactly 0 inches of snow up here. They were freaked out yesterday. They canceled all of the schools. Everything got canceled. Got up here, and it's just been raining. But the conference, which is HubSpot's Flywheel Kickoff, which I will say this, and then we can't really talk about it, but like every single slide that is there has a shh on it. So I'm not allowed to talk about the conference. I can show.
Oh, it's secretive. Only the 10,000 people there can know.
But I have a sticker. I think I can show a sticker. I have a sticker that says Flywheel Kickoff. Here's what I will say. This is actually interesting. This is why being a CEO is great. Yesterday there was breakfast, and I sat down at breakfast, and all of these people. This is the first Flywheel Kickoff where they've gotten the entire growth team together, which is pretty cool. Ever 5,000 people, and they have not held an event like this for 4 years. 4 years. So all of these people are meeting each other for the first time. So sitting down as a CEO of my own company at breakfast and watching all of these people meet each other for the first time was amazing. Mm-hmm. That's why we do this. That's why we have this, like, we're just like literally watching these interactions where these people have communicated on Zoom for years, literally years, and have never met each other, and then do the whole like, oh my gosh, you're so tall thing is actually pretty funny.
HubSpot didn't have like an offsite or invite everyone to Unleash or something?
Inbound, they don't invite any of their employees. You're like not allowed invited to inbound.
Really?
Right. Yeah. HubSpot employees are not allowed to go to inbound.
Interesting.
Up space for us paying customers. Yeah.
Wow. So AJ got to go to the big one. The Dublin one was the one I was at, but that was, 100 people instead of 5,000.
It was 100?
Sam,
how many was it?
You've been to Dublin a couple of times now in the last couple of years, and Dublin's really interesting because there are a lot of tech companies that have offices there because of tax reasons. So it's become a bit of a hub. How has that city evolved or the ecosystem evolved since you've been growing?
I've only been 3 times in my life. So, but over the past, what I will say is that it's young, dynamic, and very charming. That's what I would say. The Irish are so lovely. They're actually lovely people, and they're so happy. And there is a sense of something happening at the same time that it doesn't take very long to go into a part of the city that feels much more working class and much more provincial and much smaller. But, last week I was only there for 18 hours. I landed on a red eye at 9 a.m. I slept till 2. I went for a run around the River Liffey. I went for dinner. I woke up the next day. I did a thing for the HubSpot FKO in Dublin. I then went to the airport and flew home.
Wow. You missed a really important thing during that. You filmed Topline during that.
And I filmed Topline, right, exactly.
Highlight of those 24 hours. Wow.
Sam, if you could move like Pavilion to headquarters, whatever that means, to any city in the world, where would you move the Pavilion to?
What a question. If I had to move it out of New York, because I think New York is the most logical place. What a question. I don't know. I mean, I would like to, let's rotate it every 6 months to London, Paris, Barcelona, Denver, Boston, Los Angeles. I love all of these places. Austin, Texas.
You didn't say Salt Lake City in there. We got a
not
hard
yet.
sell.
I didn't say Salt Lake City.
It's coming.
Philadelphia.
Yeah. Okay. Yeah.
Your pool in the summer.
Yeah, I could do that.
With Andrew and the kids.
I could do that. I'm going to host an STA Pavilion Quota Path party at some point.
I love that.
AJ, would you like change Austin to something else?
Yeah, I think so. I think I'd go this is more, if it was global, I think Singapore is like this magical beacon. I know it's not
really, it's
not
so boring. It's like the most vanilla place on earth. Why would you want to live there?
I don't know. Yeah. Okay. Wow.
Let's not alienate our Singaporean listeners.
This is the most existential random question I've ever asked on the show, and then Austin is just destroying me right now. It's like,
didn't expect Singapore. That's such a wild choice.
I think London. London is probably the right
London's
answer.
a good one. London's good.
Why? You guys just want to be robbed once a month?
What are you talking about? It's the gateway it's the gateway to all of Europe. It's the gateway to Russia. It's the gateway to Dubai and the Middle East. It's cool. It's a great place.
I have a cousin who went to school there. He was living downtown. He was robbed 6 times, I think, in like 4 years or something like that. Wow. Like, it's a pretty unsafe place to live. But probably it's obviously where you go. It's historic. It's beautiful.
Here, random fun fact though, while we're talking about this, listeners will enjoy this. Is my wife and I are actually getting our.
Will they though?
This is just about me. No, it's kind of interesting fun fact.
AJ is asserting that you are enjoying this following episode.
We are getting our heritage Italian citizenship right now because our grandparents, both of our grandparents were Italian. My wife's grandmother and my grandfather, and we're just going through it. So it's like a really fun activity to go learn your family tree and all of the things of where your family is from. But if you're Italian and you have a nationalized grandparent, you can get your citizenship.
This is a statement that a Pakistani will never make. Like no child of like immigrant Pakistanis like, I'm trying to get that passport again.
I want to go back to Pakistan.
Yeah.
It's too safe here. Let's go back.
I missed the suicide bomber.
Yeah, let's get in. Okay, so on that note, let's jump in. We have a fun docket today. So we're going to talk about SaaS metrics and how we've overcomplicated them. We're going to talk about inflation coming in hot and what that means for all of us. But we're going to start with M&A. And we're going to start with M&A because one of our themes or predictions for 2024 is that 2024 is going to be the year of M&A. There are a few reasons we feel this way. We discussed a couple of weeks ago how Series E valuations came up in Q4. And that's the stage where right before IPOs happen, but the IPO window is shut. And The Information had a really interesting article where everybody says that for the window to open, one of these big tech companies has to go public, like a Stripe. And so they've named this group the Shy Five. It's the 5 companies that we need to go public that don't want to go public. ByteDance, SpaceX, Stripe, Databricks, and Canva. And they're not projected to go public in 2024 anymore. Why? Interest rates are not coming down till later in the year. And that's when the election is going to happen. And there's turbulence in the market when the election happens. So why go public in a risky environment when you can just stay private? You have the resources to do so. And one big reason why companies want to go public at that stage is these stock options expiring for their employees. But these companies have figured that out. So if Series E valuations are up, but the public markets are shut, M&A is usually the outcome that people are thinking about. It's also a really good macro setup for M&A with valuations being low, but interest rates coming down in the near term. And yesterday, The Information reported that the big PE firms are trying to build up a bigger war chest for M&A this year. And they're doing that by hiring the top wealth managers at firms like Goldman so that they can start raising money from these super rich people in the world. And then lastly, SVB had a new report that came out a couple of days ago. Sam, you shared it with us. And in that, there was a lot of really interesting stuff in there. But this one was really startling, which is that by December of this year, 50% of startups have to raise money. And so if they can't raise venture, what are they going to do? They need a soft landing. M&A is the soft landing. So Based on that last point, it seems that many companies are going to be trying to raise VC while simultaneously probably having to activate M&A options as well. Sam, what are the signals that it's time to get serious about M&A, and how do you get ready for it mentally and practically?
Well, the signals that it's time to get ready for M&A, if you're a specific operator, I think one of the things that we always talk about is being diligence ready. If you are positioning yourself to be acquired in any way, I think the first order of business is the business has to be performing reasonably well. Is it possible that your company is shedding ARR, shedding revenue, deeply unprofitable, and still an acquisition target? It is. The issue, which is the same issue as any company that needs money in any situation, which is that the logical instinct of anybody that might be a potential acquirer is to wait and see. If you are trying to sell at a current valuation or expected valuation, but you're not doing that well and you're sort of in a difficult position, my instinct as an acquirer would be, let's see what's going to happen in 3 months or 6 months. Maybe the price will become even cheaper. And so that means that, the best companies are bought, not sold, which means that you can try and position yourself for M&A, and there's smart things you can do. And that's what AJ did with Trendkite. But I fundamentally think that to really be well positioned, your company has to be doing well. So let's say you are doing well. The next step from my perspective is, again, being diligence ready, which just means if you haven't been audited, maybe you consider being audited. But at a minimum, there are controls in place. You have a sophisticated finance function. You have the ability to produce reporting that underscores and demonstrates the ability to validate all of your key metrics and assumptions. All of your customer contracts are easily accessible. Everything is available to be, which is what you need to do to raise money anyway, but you just need to be prepared so that, because the thing that will kill the deal is you saying that you're doing a certain amount of revenue or have a certain type of churn or net revenue retention, and then it becomes clear that you weren't calculating it correctly. You didn't have a sophisticated enough finance function. You were taking some shortcuts when you were doing those calculations, and the consequence of it is that the business isn't what it presents itself to be. And because M&A itself is so finicky, and it's far more likely that the deal doesn't happen than it does happen, you really need to make sure that there's no unforced errors when it comes to positioning yourself. The last thing I would say, how do you know if you're ready? And I mean, there's no ultimate way to know, but one of the things that's on my mind for my business, not that we're not in a position where we will be in a position to be acquired in 2 years. And what I mean position to be acquired, I don't mean that we will be for sale. I mean that we will be healthy enough that I won't need any outside influence at all, which of course is when to he who hath much more shall be given. When you don't need to be sold, that's when people come calling. But one of the things that you need to build into the business that I think is resiliency and what Nassim Taleb would call anti-fragility.
Yes.
And so what that means is customer concentration or de-risking customer concentration. It means demonstrating, and this is what we were talking about on our group chat before we got on, which is demonstrating that these businesses can live without us as the founders or CEOs. That, I think, is the key valuation question specifically about Pavilion, because Pavilion, if you wanted to call it a cult of personality brand about me, that there's a potential that you could interpret it that way, which is what I posted on LinkedIn, today about the strong January that we had, which is why our chapters are so important, because the value of the community can be self-evident if the community self-organizes and is resilient upon itself. If there are chapter heads and leaders and people all over the world that are supporting Pavilion as an entity without me having to be the face of the brand at all times. But and in another business, that might be, hey, no customer should represent more than 20% of your revenue, right? You need to demonstrate that there's not such critical key man or key customer risk that should you lose that customer, everything goes away. And that's not really like on the precipice of M&A. That's leading up to it. How do you demonstrate strength of enterprise value? And one of the things that comes up for me, because I will say that I was on the phone with a CEO this week who is in a fundraising process and who is in danger of losing a top customer and was nervous about it. And that's a situation that that's a reality that impacts the valuation of the business. If one customer represents more than 20% of revenue and they might leave, that obviously heavily impacts enterprise value, even if they stay. It's not the same thing as having 1,000 customers represent, the collective same amount of revenue. So those are the things I would say. And then the last thing I would say, also, only to underscore a prediction, is that also two different members of Pavilion in this week have, one of them was just acquired, hasn't been announced yet, and another is in confidential due diligence.
Wow.
And AJ knows this because AJ was also part of the support team over the weekend that helped talk to this person and prepare them for the sale. But those are two little data points that tell me that we're correct, that sub 200, sub 300 million M&A activity is starting to pick up, and that there's going to be a lot more activity this year than last year.
Even below that, Sam, my cousin has raised a $600 million fund for PE, and they're focusing on SaaS businesses between 2 to 5 million in revenue. Growth can be stalled, but churn has to be low. That's kind of and in an ideal world, it's in a vertical space where they can do a roll up. And then they're looking at services businesses that are somewhere between like 5 and 15 million in revenue. Similar, if churn is low, they don't care about growth as much. Like, they feel like they can figure out ways to grow those businesses. And these multiples, like if you think of a SaaS business, 2 to 5 million in revenue, they're doing 4x to 5x multiples on those acquisitions. So there'll be some acquisitions in that 20, 30, $50 million range as well. There'll be a lot of activity, everywhere from 20 to like a couple of $100 million. Question, AJ, is that the belief is, or the thing that people say is that many companies are bought, they're not sold. And others say that the best time to be bought is when you're not looking to be bought, right? But
I think that
not
was
everyone
the Sam Jacobs quote, by the way. That was a Sam quote.
I don't think that's, I'm paraphrasing.
We're attributing that to him.
I'm a synthesizer of the universal
synthesizer. Not everyone has the luxury of waiting, right, to see if somebody pops in and wants to buy them. And just like not everyone can just sit back and hope somebody comes and buys their solution, we have to evangelize. And so what are some thoughtful, strategic ways to create acquisition interest? And is there a difference if you're trying to be acquired by PE versus a strategic, or is it the same set of things that you need to be doing?
So first off, Asad, why didn't you tell us your cousin has a $600 million PE? Does he want to buy a podcast with three big
Oh my God.
I literally texted you guys. This is how much I texted you and said, hey, this happened. So let me know if you guys have some companies that need to be bought.
Yeah, we have a roll up of 3 founders that have a great podcast.
This would be the funniest conglomerate: sales recruitment, sales composition, sales community. It might work. It might work.
Just the podcast is worth 10 million, in my opinion.
For sure.
Also, to answer your question, first off, I think the thing that founders have to keep in mind is that they cannot present a position of distress. You have to always have leverage in a situation. If you're coming in with like a fire sale mentality, that's going to get read immediately. So Sam had the right answer for diligence, but it doesn't matter how diligence ready you are. If the founder's not evangelizing and coming in with like, hey, this is why 1 + 1 = 3, or whatever the story is, whatever the narrative is, you're going to get laughed out of the room. So first things first is just make sure you're confident about why this is the right thing to do in terms of a partnership. Like, that's what I would think about. If you're not fundraising, then you're thinking about what are the strategic levers that I have in the business that helps accelerate other businesses. Like, that's what I like. How do I win if I have a startup coming to me and saying like, hey, we're looking for a soft landing or whatever the case, or I want to hear, I'm trying to fundraise. AJ, can you help me fundraise? I would first like look at the deck and better understand where the win is for QuotaPath. Most founders are always positioning it from like their point of view. So like, that's the thing I would do. Here's some tricks of the trade. A couple of things. Actually learned this. This was actually really good advice today. First off, branding and thinking about the value props in the other company. So if it's HubSpot, like having their logo of like where this fits, having the positioning of HubSpot's positioning first and foremost, that will resonate really well. The other thing I thought about is if you're at like an event like this, is hang out in the lobby of the hotel. you're going to see a lot of the executives or a lot of the people that you want to talk to and understand that positioning come through. That happened last night, and there's the CCO, Chief Customer Officer, just met in the lobby really randomly because of that, and learned a little bit more about the positioning of it. So if I'm going to have a conversation with the CEO of the company and thinking about that, those conversations I can recall. So position yourself.
Mm.
I'm jumping a little all over the place, but everyone just thinks like, oh, you know, QuotaPath was lucky or whatever. But all of these relationships that we're building started years ago, and they're just so slow to do it. So fun. It's different than
So
fundraising.
actually, let's click on that,
Yeah,
right? So there's two ways of doing this. One is you are long-term strategic, right? So you're building towards an acquisition years down the line. You build these
I don't
relationships.
think I don't think you're building towards an acquisition years down the line. I think you're building towards optionality
that's
years down the line.
100% what you say.
That's why AJ's point is
Yeah.
about partnerships, right? It's not about like, it's just invest in relationships outside of your company as early as you can, because you never know what's going
I'm
to
not
happen.
thinking about the M&A. I'm thinking about the end of 2025. I want us to look like X to have the optionality to do Y.
Mm.
It's exactly what Sam
Right.
said. So it has nothing to do with M&A, which is why I think founders get tripped up, because they think about the fundraise and the fundraise event, and they're trying to create this like 60-day window, and that's just it's just a totally different experience. So the reason I was saying I love my job for it is because these strategic conversations, you're having these conversations with actual operators that are like talking about what's going on in the world today. What does the market look like today? What are the tools and platforms people are using today? Not the like, here, let's look at the spreadsheet and understand all of the KPIs and all of the metrics. That comes after the LOI would be signed. Like that's something that you do need to dig into. Sam, I do want to talk to something that you brought up, which is like, hey, there's a couple founders that I'm talking to. They're like, they're going through M&A. I agree, it's picking up. And if you're someone out there that if you're an executive or you're a founder that's thinking like maybe in the next 18 months something's going to happen, a liquidity event, start planning now. There's a lot of founders that are trying to do their financial planning like after the fact. There's not much you can do. And so just start thinking about and planning and making sure you're getting your ducks in a row. That could be trust, financial advisors, taxes. It doesn't matter. QSBS, all of that stuff that you've heard us talk about over the years. I just think since we're talking about it right now, and we've done a really good job of future casting for people out there of like, hey, this is what the world's going to look like. I'm telling everyone out there right now, start thinking about that planning and understand your equity, understand your options. We talk about this as from a secondary standpoint. This is actually much bigger, much greater. You have things like earnouts, and you have maybe a public company where you can't sell for 6 months. A lot of this stuff that's going to be happening. You want to be well informed, because I've talked to a few people myself the last few weeks, even they're like, yeah, I don't have anything. I'm like, well, there's not much you can do right now.
Or they don't even understand the nuanced terms. AJ, is there, when you're thinking about an acquisition, and let's say I'm a company, I have 5 million in ARR, I don't think I can raise, I need a soft landing, I think a strategic is better than PE for what I do. Who am I trying to target in these organizations? Am I going to the corp dev team? Am I going to some functional leaders? Like, who do I engage and build this relationship with?
A partner in a board meeting recently asked me even, who would be the GM of this acquisition? That's a great question. Yeah. Fantastic question.
You got to know that.
Yeah. And it's you have to know that, and it can change.
Corp dev is not the right people.
It's never corp dev. It's never corp dev. Yeah, no, corp dev. Everyone that's gone through.
It's never corp dev.
Zero.
No, because they're not going to be driving. They're not they're not the economic buyer. They're a service provider back to the rest of the organization.
Product is usually involved in some way. So product is usually.
It's going to be like whoever runs the CRM portion of HubSpot. That product lead will be the acquirer pushing Yamini to purchase QuotaPath. Staying on the HubSpot example, if they were going to buy Pavilion, it would be Kip Bodnar, the CMO, right? Because they'd be purchasing it for some brand affinity. They'd be purchasing it for some distribution, maybe anchoring their focus on the CRM space relative to Salesforce. Kip is the person that drove, the purchase of the Hustle from Sam Parr. So it's the person that owns the P&L. And owns like like AJ said, the GM, the corp dev people are useless.
So
they're just like doing the paperwork in the back end.
So I like, that was a great question. I kind of did some discovery on that. Found who I thought was that person, had a couple ins, but I actually just sent them a LinkedIn message, said, "Hey, we're sponsoring Flywheel Kickoff. Would love to stop by." This person is 6 months into HubSpot, so I was like, "Look, I know it's chaotic, crazy time." I went to like the 3 people at HubSpot that I know super, super well, that were there. Like, "Hey, I need to meet this person. I need to meet this person." They all told him, and then he stopped by 3 times to our booth. I wasn't there the first 2 times. The third time I was, and had a 30-minute conversation with him. So these are the interactions that matter, and that are hopefully practical and helpful for people that are thinking about this. Because look, we could sit here and talk about, like, as Topline, we can talk about M&A all day, and we can talk about the market. But what I think people really want to know is, like, what do you do? How do you actually make this thing go? And it's some of it's timing and some of it's luck, but a lot of it is proactive communication and understanding what the future is going to hold, and working backwards from that future.
There's a strategy and a question. A strategy for companies that you want to be acquired by that spend a lot of time on LinkedIn. You need to create awareness with them, right? You need them to know your brand and ideally respect your brand. And not enough people leverage LinkedIn advertising to do that. Like, if you're trying to get in front of these companies and there are people on LinkedIn all the time, within a couple of $100, you can make sure certain ads show up to just those people. And those ads can be on themes that you want to build for, so that when you're reaching out to these people or trying to build a relationship with them, they already know you. They know that you're doing well. There's excitement around your brand in front of their eyes. So that's like a tactical thing people can do. In terms of a question, one of the challenges with M&A is that most acquisitions just die post-acquisition, right? Like, these companies, the success rate of an acquisition is not very high. And so many of these founders, these companies need their founders in the driving seat for these companies to thrive and do well. And the founders post-acquisition don't stick around too long. Even at Google, the average founder post-acquisition stays 2.5 years. It's lower in other companies. And the other part of this is that founders don't just want to make money, right? Like, they built this thing, they would like to see it thrive in the world. And so what can you do, Sam, as a founder, as an executive, to ensure that your company is equipped to potentially thrive post-acquisition? Is there stuff we can do, or is this all on the acquirer side?
Well, it's what I said at the beginning of the show, which is I think you have to build in resiliency. The best systems, according to Donella Meadows, are what are they? Self-organizing, hierarchical, and resilient. And so my point is, what are the things that you can do to make yourself redundant? What are how do you build an operating system that requires you less and less, and that isolates you to set the vision and the direction? Because again, I think, if you're thinking about what is the job of the CEO, if you've got a great executive team and you've got a great team in general and you've got a great market and a great segment, your job is not to write the code. Your job is not to approve every wireframe. Your job is not to write the marketing copy. Your job is not even to speak at every conference. Your job is to direct the vision of the company through your executive team and through your direct reports. And then it is to be the external face of the company, building relationships outside of the company. So first, like, let's make sure that your company can run without you. And that's not just to sell the business. That's to make it. A lot of this is preparing it for M&A, but it's not really about preparing it for M&A. Yeah. It's about making it valuable. So how does a thing have value? A thing has value if it can live on without you needing to be there every day. And, the great news for me as a CEO Pavilion is that we've never been more valuable from that perspective. I'm obviously still the face of the company and the face of the brand and all of that. But, we launched this member hub. I had really very little to do with it. We had the CEO summit that AJ came to. I had very little to do with it. I gave one talk at the beginning, one talk at the end that was mostly like, hey, buy more stuff from Pavilion. And then meanwhile, the content in the middle was done by my marketing and by the event.
Which, by the way, did work. So because I bought a VIP CEO pass. So when you did it, it reminded me, I went to the Tony Robbins conference once, and he had this trip that cost $100,000 to Fiji and would get everyone on stage that did it. They were 600 people on. So next time, what I'm basically saying, Sam, is make it a trip to Fiji and bring us up on stage if we buy. Like, I bought it right there. You got to pull me up on stage.
Well, a lot of this stuff is the Tony Robbins idea of like hit them while they're hot and try to sell them as much stuff at the point of like maximum engagement. But the point that the bigger point that I'm making is how do you that is how you position yourself and your company to be valuable, regardless of whether it's acquired. Help it create systems and processes that enable it to run without your direct involvement every single day. And I guess the other thing I would say is, and also, if you want to work for HubSpot, get fired up to work for HubSpot. You're going to have a bunch of money in the bank. It's not going to be the end of the world. It's still a great company. There's great people that work there. So instead of viewing it as a moratorium or some kind of, prison sentence to work for a large acquirer, maybe if it's IBM or Oracle, maybe it is a prison sentence. But generally speaking, get fired up to build enterprise value. Get fired up to continue to grow if you've got an earnout or you got some vesting equity, which I'm sure all of us, if there are acquisitions in our future, will have. If there's equity that's part of it, let's make that equity valuable. Let's get involved and invested. But the number one biggest thing you can do is, again, this idea of anti-fragility. It's like, let's look at key man risk in the organization, including you. Let's look at key customer concentration. Let's look at where can we build redundancy into the business so that it can live forever without any one person required to be there.
If you're an executive, I fantastic advice, Sam. I think if you're an executive listening to this, because we're talking from the founder standpoint, I think some of this can actually apply as well, because you're leading into the business and you're engaged into the business and you're probably part of a lot of these strategic conversations. So the redundancy isn't just for the founders or the CEOs. The redundancy needs to be as part of the executive and to your lieutenants. The people matter. The acquisition of the people matter. Obviously, you want to keep that really close knit, and you don't want to tell anyone until a deal is signed or anything. But at the same time, you want to get people excited and evangelize that as well. So I think it's like, even today, time to really think about that and bring in that safety group and like tell them how you're thinking about it, so that those executives are thinking about it, not a distraction. They still need to do the business. They still need to sell. They still need to do renewals. They still need to upsell, right? But at the same time, I think getting them excited about it is something that will do exactly what Sam said, is like they can see themselves working for that bigger organization.
Well, there's a challenge here, right? Which is, if I'm a founder of like a $3 million or $5 million company that can't raise venture anymore, and I need this soft landing, but I'm not sure that I'll get it. And I also need to keep operating this business and keep it alive. And one of the best shots of doing this is being out in the field, being the key person, right? Like being the face, being the brand, like being out there. And you want your executives doing the exact same thing. So there is this like tension between, you want to show that there isn't key person risk in the organization, but if everybody kind of is saying, oh, we need to show that this company can run without us, you've got all the executive team playing golf and the company is dying. Like, that's also this tension in a founder's head. And so I think a lot of people sometimes mistake what key person risk actually is. If you
it's also at a $3 to $5 million business. Like, that's not a business at scale. If you're trying to sell that business, It's a very different situation. That business needs to do whatever it needs to do to survive. I'm talking about a 20, 30, 40, $50 million business. Those are businesses at scale that need to build in that redundancy.
Sam, that's a really good point. So what's the point at which
I just wanted to make sure it was clarified, because Sam's point last week was there's going to be a lot of these like $400 to $800 million acquisitions. And like, that is the strike zone, the $20 to $50 million in revenue for what those will look like.
3 to 5 is like a 20 million, 15 million, maybe it's 10 million, maybe it's we just hire all the people and don't fire them.
Acquihire,
So Sam, what's the point at which you take out key person risk, right? When you start optimizing for this? Because in my mind, I think if you're a company between 0 and 10 million in revenue, do what you need to do to survive and thrive. And then after that, you start feeling a little bit more like a growth stage business. And then you start saying, okay, now let's optimize. Would you agree with that statement? Do you think about it differently?
I would agree with it. I think 10 million is when Jocko says you got a revenue factory. Company. You're right, Asad. If you're 3 million, again, we're just like, let's make sure it is actually a company and not, 3 big customers that are signed on for pilots.
Yeah.
Okay. we have beaten this on its head. We've done a good job there. We're going to pay some bills, and then we're going to come back and we're going to jump into the market.
Hey, CMOs and marketing VPs, that's Chief Marketing Officers, join Pavilion in New York City, the Big Apple, for the CMO Summit on April 18th. The CMO Summit. At CMO Summit, you'll connect with other amazing B2B marketing executives and learn from folks like Udi Ledergor from Gong, Latny Conant of Sixth Sense, Andrea Kale of Help Scout on topics like mastering the customer lifecycle, AI and marketing, and building an iconic brand. Register now at joinpavilion.com/CMO Summit and use the code Topline for an exclusive 15% discount on your ticket. That's joinpavilion.com/CMO Summit and the code Topline for an exclusive 15% discount on your ticket. I will be there, and I look forward to seeing you there. It's going to be fantastic.
Okay, so we have some macro news over the last few weeks. Firstly, yesterday we got the inflation reading, and it was higher than the market was expecting. The market wanted below 3%, and we got 3.1%, which is still a smaller increase than the 3.4% from the month before, but the market didn't like this. And it gives a lot of reason for us to not expect a rate cut in Q1. We also got the jobs report in January, and it was hot. There were 353,000 jobs added in January, which was a 12-month high. They also revised the December number by 117,000 jobs, bringing it to 333,000. People don't track these revisions. These revisions are wild. They're like 50% revisions. It's not like we went from like 200,000 to 207,000 jobs. It's like fundamental changes. And the unemployment rate is at 3.7%, which means that we have had under 4% unemployment for 2 years in a row, which is the last time that happened was in the 1960s. The last thing is that the cloud providers had their earnings calls. And while we're not public market analysts, we do like looking at cloud usage because it's a barometer of where the market is going and what trends are playing out. And all of them saw an acceleration year over year. And in their earnings calls, they indicated that their customers, many of whom are startups, they're done with pure optimization and cost cutting. And where they are now is this new normal, which is adding new workloads, then optimizing those, then adding new ones, then optimizing those, which is interesting. So it's clear, Sam, that we're not getting the Q1 rate cuts that the economy was hoping for, and the economy is not going to magically jump back to good times. But we also see sprinkles of good news along the way. What does this inflation reading mean for things like equity value and M&A and all of that?
Well, I think I don't think anything's very different than anything we've been saying over the last couple of weeks, which is that the companies that have positioned themselves to succeed in a good way through this year, there's nothing that we're seeing. All of these, the interest rates are important for the value of your stock portfolio, and they're important for the likelihood of a company to use equity to buy your company. And they might have something to do with your ability to raise money. But generally speaking, the economic data is very positive.
Yeah.
That's why interest rates are going to stay high for longer. And that means that I think we all have an opportunity to continue to drive good, profitable, efficient businesses. And again, we're in this world of profitable, efficient growth versus growth at any cost. And I mentioned a few times, but we had a really strong February. We're on track to hit our February growth targets. We're on track. I mean, we're pacing ahead of our overall 2024 plan. It's only 6 weeks into the year, but nevertheless. And the good news is we just got our January financials, and it looks like we have close to over, in January at least, we had like 13 or 14% EBITDA margins, which again, we lost money the last 3 years. So that's obviously awesome. And because of deferred revenue, we collected way more cash than that. So what does all of that mean? I'm just speaking from my own experience, right? Just giving people some real data. So I was on a one-on-one today, and and we were looking at the money that we're spending on basically customer acquisition costs, but really it was the sales team and the CS team a year ago when we were much larger versus the team that is today. And the comparison of base salary difference, it's about roughly $2 million that we were spending annually a year just in base salary, not including commissions. And it's 10% of that roughly. Maybe it's like 12% of that today. So we have reduced our base salary investment on customer acquisition or customer support, whatever you want to call sales and CS. We've reduced it 90%. Retention is up year over year. And new business acquisition is slightly down, but only relative to the fact that we used to have like 5 SDRs and 6 AEs, and now we just have 1 account executive, and we just hired somebody new that started last week. So what does that mean? How do you navigate this new world? How should you be thinking about it? My point is that I think the number was like 20 people, maybe it's 15 people. There's a total of 3, one of which is new, started last week. So we went from like 15 people, maybe 17 people to 3 people. We went from an unprofitable business unit because, again, I've talked about this in the past. We did business unit level reporting on our corporate business to significantly profitable. We're beating all of our targets. How are we doing that? Focusing on great talent, flooding those people with great opportunities. All of them are more productive. That's why quota attainment went up last year. That's why QuotaPath is doing well. So what's the lesson of the day for all of us in the reality of this economic data? It's, I guess what I would say, which I've heard other people say in other shows, podcasts, and commentary, is you can't blame the economy anymore if you're not at least seeing signs of improvement, signs of growth. Doesn't mean you have to be tripling this year, but if your business hasn't improved from a year ago to Q4 and through January of this year, then it's probably something in your execution. It's probably something in the quality of your team. It's not probably a macroeconomic reason. Whatever is happening in your business is now more than ever under your control, because you might have the absence of a headwind. It might not be a full tailwind, but there are opportunities to grow. There are opportunities to be successful.
Yeah,
you're not running downhill, but you're not running uphill either.
Exactly. What do you think,
no,
AJ?
I 100% agree with everything you just said there. I think we've talked about this, the shock to the system, and nothing's really changed, but the signaling. Last year we talked about green shoots, and I didn't really know what that meant, but you kind of see it. You see it at that moment in time, and you're like, oh, this is what this actually means. And that's what you focus in on, and you get your team excited about those things. We've talked about the evolving door of product market fit. I think what Sam's ultimately saying is if you're still in what you were feeling last year to this year, then you don't have product market fit. And that's where the team,
or there's something wrong. There's something wrong that needs to be fixed.
Yeah, you didn't do the work to like figure out what your customers were really asking for and what they really needed when things were starting to change around. We're not out of the woods yet. I still go back to that chart that we looked at. It's just going to be the downs and the ups and the downs and the ups. We'll navigate that. But there isn't the shock to the system. On the macro level, I don't know, Asid. To Sam's point, we're not analysts, so we couldn't really, or your point actually, we're not analysts. You threw that in there. I love that. That was like the little disclaimer that you added. You're like, we're not analysts.
Yeah. Don't make investments based on this, dudes.
But
AJ, but here's one that's connected to this point around the improving market. We're in this really interesting zone right now where things are getting a little bit better and a little bit easier, but we're still it's still hard. It's not magically easy. And this is a fun part of business. This is a fun point to do business in, because you can move things in the right direction, but you're not going to get immediately lazy because things flipped on their heads. One of the things that it seems that there's work to be done in our ecosystem is around how we measure and monitor our businesses. We have overcomplicated SaaS metrics is this theme that our friend David Spitz has been talking about. And he did a number of LinkedIn posts where he kind of broke down why and how, and just, for why his point of view on this is important. He's one of the people that came up with the original set of SaaS benchmarks and metrics that we all look at. So he knows this really, really well. And he gave a couple of examples. One he said is that LTV to CAC, it's ridiculous. How can you trying to think that you know what LTV is absurd. That was his point on that. And that makes a lot of sense. He thinks a better approach would be the CAC ratio, which is taking the sales and marketing costs and dividing it by your new ARR and getting a ratio there. And if you want to get super fancy, you can do it by net new ARR and upsell and expansion ARR. And if you see a difference there, you kind of know where you have opportunity and where you don't. He said CAC payback is also a challenge because it makes you, just because you have high CAC payback doesn't mean you have a horrible go-to-market machine. There are many companies that he's studied that have high CAC payback initially on new business, but then the CAC payback on expansion and renewals is actually very low. And that engine is still a good engine. So AJ, you run a quintessential SaaS business, and you've seen this journey from early stage to quite a sizable amount of revenue with Trendkite as well. I think that was Series C. So what do you look at? Because there has been this overcomplication. So what is your way of looking at your business? What matters? What doesn't matter? How do you look at it?
I mean, Sam has talked about his metrics, and the metrics you just cited that were David's are different than the metrics that Sam talked about on purpose, because Dave Kellogg had a really good conversation with Harry VC about this, of like, there's the operator metrics and then there's the investor metrics. And then the operator metrics that Sam literally just told us, what is that EBITDA margin, the things that he's caring about, that's what he's talking about. Now, is he talking about at the board level? Probably 100%. But it's ultimately where last year was a challenge, was that we had this whole thing of KPIs and metrics. We didn't have any benchmarks. We didn't know what great looked like. And we were just like trying to like figure that out. So it caused a lot of challenges where we would like, okay, I guess I'm going to just focus on my bank account, because that's one number that I can at least look at. And that was challenging. To answer your question, Asid, I focus on our North Star metrics: percentage of customers that are running payouts within quota path. Are customers successful? That's the metric that I care about. If that metric is healthy, then the rest will take care of itself. But the team needs to focus on that metric right now. And so just one metric.
Interesting.
It's just one metric.
Wow.
Are customers running payouts?
Essentialism, simplicity. That's good. Okay. On that note, let's move to shout outs then.
Ooh, shout outs. Wins of the week.
Wins of the week. Shout outs. Predictions. Do anything you want.
I am going to shout out Samantha Manley, because Sam just said we had our team on quota attainment last quarter. Sam just hit her Q1 quota attainment with a deal. Sam and I have worked together for 7 years. 7 years.
Wow.
She's one of the most loyal people I've ever met in my entire life. I have a great story about trying to hire her, which I'll tell really quickly right now. At Trendkite, I sent her a LinkedIn message because 4 people were like, you have to hire Sam. And I was like, okay, Sam, please talk to me. Please talk to me. That was basically my message. And she did respond. And then I talked to her. I met her for coffee, which I forgot my credit card. So I made Sam actually pay for my coffee at that time. This is 2014. And then every quarter she was like, AJ, I'm not ready. Every quarter for 2 years, I sent her a message. And she joined me eventually 2 years later. And I've worked with her ever since. And she's been the most consistent seller I've ever worked with. She's the hardest worker I've ever worked with. She's a mom of 2 today. And she is just a phenomenal human being. So Samantha Manley, thank you. Shout out to you.
Brilliant. Shout out to Samantha. I'll go on, Sam. You end it then. I saw a really interesting post, one that I really liked. There's a COO of a company called Merge. I don't know Merge and I don't know the COO, but the post was great. And she basically spoke about how she flew from New York to San Francisco in the morning, grabbed dinner with a candidate that she wanted to close, and then took the red eye back. And she's like, it was horrible to do it like physically, but I closed the candidate. Effort and heart matters. And I just love this. I love when people go the extra mile to build world-class teams, because it's not easy to build difference maker type of teams. Like, it's really, really hard. Even if you have great investors and a lot of money in the bank and all the beautiful signals that every tech company has, it's still hard to close the 1%ers, because there's only 1% of them out there and they have lots of opportunity irrespective of the market. And so I just found that a COO who went this extra mile to close it is the right type of COO, number one. Number two, what a great partner to the recruitment team. And then I later found out there's a person I know, Christiana Molina Hart, who's actually one of the best go-to-market recruiters in the world. And she's the go-to-market recruiter there. And so when you combine these two people, that's a company that can build a great team. It gave me energy to see that action. And so shout out to them.
I love that. I'm going to shout out a few people. I shouted them out last week too, but now I'm going to shout out our members, the Pavilion members. So a little brief story. You know, we spent 2 years trying to build a digital hub that wasn't going very well. And when we talk about like daily active users or monthly active users, it really was sort of like fake conversation because it was always like the handful. It was like, did 8 people, you know, log in? And of course, there was nothing to do when they logged in. The ops team, our ops team at Pavilion, when we decided to disband our product and engineering organization and move to an operations-led function to build our member hub, they stood up this platform in 6 weeks. We've sent 2 emails. We sent an email to all the people that attended our AKO last week, and we sent an email a week ago when you're listening to this last Monday telling executive members they should log in. As of today, there's 1,078 active members off of one email.
Wow.
In our member hub, which is absolutely incredible. It's over 25% of our entire executive membership. We have 10,000 members, but 4,000 executive members, or just over 4,000. And that's one email. One email. And if you go into the member directory and you zip around, you can see people all over the world. You know, I used it to see that somebody that listed Vancouver as their home chapter was in Nova Scotia. So I sent him an email saying, hey, are you sure you want to be in the Vancouver chapter? He said, good. Thank you for calling that out. I want to join the Toronto chapter. I introduced him to Butch and maybe to you, Asad.
Yeah.
Because the guy's name is Jeff Kinsley or Nicely. Anyway, so operations team and the Pavilion member hub. And then last thing is my good friend Rick Smolin just launched his own podcast called Pillar Talk. And Rick's a great guy, one of the great CROs. He's the CRO of Ship Hero. He used to be the CRO of Lupio, a great sales leader, good person. And everybody should check out his new podcast, Pillar Talk. I will be a guest on it fairly soon, and we should bring Rick on the show sometime to wrap sales leadership at some point.
Rick's a fun man. Okay, I love that story. That's a crazy conversion rate, by the way.
It's crazy. It's like crazy. It's wild. It is wild. It's cool. So
wow. Okay. Well, you can have conversion rates like that in life. So you can have these conversion rates. It doesn't have to be 1%.
A credo to live by. Conversion rates matter.
Yeah. Because we're told that like these conversion rates, like good looks like, and you look at what good looks like, and it's horrible. Like a couple 1%, 2%, 3% of people convert on something. It's like, but why can't it be 30%, 40%? I love that. Shout out to the team.
Check out the member hub, everybody. It's really, really cool. We're super excited about it.
That's the pod. Okay,
thanks for listening. We'll talk to you on Thursday for Topline Hotline.
All the best. Bye.
This episode was brought to you by the book Ecosystem-Led Growth, a new book by Crossbeam CEO Bob Moore. Pre-order your copy at elgbook.com. That's elgbook.com.
Thank you for listening to this episode of Topline. To learn more about the trends, news, and developments impacting the world of B2B SaaS, head to joinpavilion.com, where more than 10,000 of the world's top go-to market leaders go to achieve and unlock their full professional potential.